I'd like to welcome my special guest, Robert Hormats, Bob Hormats, Vice Chair of the Kissinger Associates, Inc. But many of us remember him, of course, as a former Goldman Vice Chairman. Big resume. Thanks for joining me today, Bob.
Great to be with you, Rick, always.
Okay, today we learned something I think is actually big. First of all, we had this massive move in interest rates from Thursday evening, Friday morning to today. And the catalyst, obviously, the Mexican surprise. How do we know it's a Mexican surprise? ISM today, Bob, was released. It was on the weak side. And the respondents' comments, which were gathered before the Friday last week's surprise regarding Mexico, still included Mexico in many of their comments. We're transferring many of our supply chains from China to Mexico. The tariffs has forced us to change the way we do business, shifting more business from China to Mexico, and boom, now Mexico is drawn into this. Can you try to tie it up for us?
Well, I think the underlying theme is uncertainty and unpredictability. These supply chains have been developed with China, and now to a greater degree, as you correctly point out, with Mexico, for a long period of time. The idea is to develop between American companies and foreign companies close supply links, which are designed to help improve the competitiveness of American companies because they take foreign components and incorporate them in goods that they produce in this country. If you disrupt those supply chains or cause uncertainties, it causes a lot of problems for American companies. A, their costs go up, and B, the uncertainty of the availability of supplies go up. So these uncertainties have a major effect on the market and also on investment plans over the medium term.
Now, let's shift gears and spend more time concentrating directly on China, Bob. Last time you were on CNBC, you were talking about that the stock market has already bet on a deal. And it's pretty hard to argue with that, even though the influences of the Mexican trade surprise has been an outlier that's affected the markets. Do you still think a deal is possible? And how do you think stock investors, whether domestically or globally, will proceed at this point, considering how the talks broke down?
Early on, when I was on last, as we were moving toward the beginning of May, there was every signal coming out of Beijing and out of Washington that a deal was very close. Then something happened. First of all, I think the U.S. pushed on some of the red buttons that caused China to take a different position that said, look, the U.S. is pushing us too far. And we shouldn't forget that China has public opinion too. And China has to, even the fact that it's run very differently than the U.S., has to deal with inter-party pressures on Xi Jinping. And I think he felt, and they've said this, that their own sovereignty and intrusion on their legislative process by the United States was causing a political reaction in China, and they pulled back because they thought the U.S. had gone too far. Now I think there is still a possibility of a deal, but I think it's going to take a lot longer. And now the problem is even worse because it's not only tariff escalation that is occurring, it is escalation in terms of restrictions on exports, restrictions on investment, the so-called entities list of restricted companies that the U.S. is adding Chinese companies to, and the Chinese are creating their own entities list. So what we really have here is we're on a path toward mutually assured disruption. If this kind of trade war continues, it'll adversely affect both sides and both economies, inflation and slower growth on both sides, which hurts other economies too, because they trade with the U.S. and China.